Two central banks, two different stories. First, the Fed sending markets into a spin with a more hawkish, more upbeat outlook than many expected. And then the Bank of Japan hinting at the opposite. While on hold now, policy there may have to be more accommodative in the future.
There are more downside risks to Japan's economy. We especially need to pay attention to the China-US trade war.
Most of my colleagues expect the economy to continue to perform well in the coming year.
The BoJ's warning, and the many others like it over recent months, is exactly why the Fed's latest action came as a shock. Its quarter-point rate hike priced in, but not the two hikes its latest forecasts imply for next year. That's triggered a broad-based sell-off in stocks, some Asian indices now slipping into bear market territory. US bond yields fell hard too, on a fear further Fed tightening could suffocate growth.
What the markets are currently pricing in is one rate hike maximum. Whilst the US economy has been in a very strong place in 2018, US markets have actually taken a hit. The S&P 500, for example, is now down 10% in the year to date.
To complete a trio, the Bank of England left rates on hold on Thursday. There was little surprise over that. Policymakers warning that Brexit uncertainty had intensified considerably.
There's certainly no expectations of an immediate rate hike. That being said, of course, the UK economy has shown some resilience. Some would argue that if it hadn't been for the Brexit uncertainty, it would have seen rather more GDP growth than it has.
The latest UK figures show Black Friday helped retail sales volumes jump by far more than expected in November. Though even as they were released, economists spoke of a rare bright spot.